10,000 XRP could change your family's life forever. There's a post here by Rob Cunningham talking specifically about that. Let's dive into this. We also just passed $1 billion into spot XRP ETFs. How much is expected to go into them in December, and how much XRP is really left on some of these OTC desks? We also have a ton of other information here. We got a good new video here from Sal Galbati and this gentleman talking about XRP. But let's start here. The 10,000 XRP family generational model. How one wise decision reshapes 100 years of a family's destiny. Year 0, the family foundation. The founder accumulates 10,000 XRP. Price today doesn't matter. The starting point is the decision, the family rule. We will never sell XRP. We own, we stake, we borrow, we build, we teach. Year 10, XRP at $1,000. Now you hold basically $10 million. You're officially a deca millionaire on paper without selling anything. The entire foundation of this idea is built on patience, discipline, and treating XRP not as a lottery ticket, but as a productive asset, something that creates yield and opportunity without being sold. Income Scenario 1. Simple passive yield at 4% annually. This is considered conservative for sophisticated institutional staking, lending, and structured yield products inside a mature XRPL world. 4% on $10 million is $400,000 a year, and you still own all of your XRP. That's $33,333 per month for doing nothing but holding an asset and waiting for the world to catch up to the movement that Ripple is pushing globally. Income Scenario 2. Borrowing against your XRP like the wealthy do. You borrow 10% of your collateral value. That's $1 million loan at 3% interest. No sales, nothing taxable. You're simply accessing your own liquidity without breaking the compounding engine. That $1 million can buy rental real estate, fund a business, send your kids to school, acquire more assets, or invest in yield-bearing opportunities, whether that's stocks, bonds, or other large cap assets. The wealthy borrow, the wealthy leverage. The wealthy never liquidate their golden goose. This model takes the same approach and applies it to a high-utility institutional asset like XRP. Income Scenario 3, the mixed strategy. You're taking the $400,000 in passive yield plus the $1 million in cheap borrowed capital. Both together with 0 XRP sold create a framework where the family is living a banker lifestyle, not a consumer lifestyle. And this is only year 10. Watch what happens when you extend this same discipline, the same mindset, and the same rule. We never sell the asset into decades instead of years. Year 30, XRP is at $5,000. Your original 10,000 XRP is now worth $50 million. That's $50 million built from patience and understanding that major infrastructure assets grow with the global system they're designed to serve. The 4% yield alone produces $2 million per year, $166,000 per month. This is the moment people start adding up their rent, their car payment, their insurance, their lifestyle expenses, and realize wealth doesn't come from luck. It comes from owning an appreciating asset that compounds quietly for years while the world ignores it. And this isn't just about buying luxury things. This is where generational transformation happens, ending poverty in the family line. Funding education not just for children but grandchildren. Purchasing property, supporting missions, causes, ministries, charities, building organizations, creating businesses that employ people, eliminating debt traps, giving future generations a head start, not a handout, a foundation. Income Scenario 2. At this stage, borrow 20% at 30-year terms. That's $10 million at 3% interest, collateralized, not sold. With $10 million in cheap capital, a family can acquire commercial real estate. Portfolios, build community developments, buy farmland, fund multi-deed business ventures, create a school or academy, set up a foundation, or establish a permanent endowment that lasts generations. The XRP remains intact, every token untouched. Income Scenario 3. The family bank model, a family trust, a family bank entity, a yield and lending engine, an internal financial ecosystem that compounds forward indefinitely. Annual life cycle, $2 million in yield income, $10 million in collateralized credit, 0 XRP sold. This becomes a 100-year machine, a system that outlives the founder and stabilizes every generation that comes after. The true power isn't just the numbers, it's the mindset. Teaching children and grandchildren how to own assets instead of chasing consumer debt, how to never sell the golden goose, how to live off yield, how to borrow smart, not sell dumb, how to think like a banker, not a shopper, how to use patience as a weapon, how to avoid the traps of inflation, interest, scarcity, and emotional spending. This is how families go from working class to stable, from stable to prosperous, from prosperous to sovereign. One decision becomes a turning point. And that turning point is the accumulation and protection of an asset with global utility and global adoption. And Rob's post nails this point beautifully. Every family has one turning point that changes the next century. For this family, it began with 10,000 XRP. Ripple and XRP aren't hype. They're commodity-like digital infrastructure, programmable money with global liquidity, settlement speed, and institutional demand. A father teaching his family, we never sell the asset. We become the bank. Fast forward 10 years. XRP reaches $1,000. Their 10,000 XRP becomes $10 million. Zero sales. Just patience. 4% yield produces $400,000 per year. The family borrows against the asset, a $1 million credit line funds. Expansion, business creation, education, and opportunity. Repeat this cycle for 20 more years. XRP reaches $5,000. The account hits $50 million. The yield generates $2 million per year. No selling. The family shifts from consumers to creators. When you look at the ETF flows, it becomes obvious that this shift isn't theoretical anymore. It's happening in real time. XRPFS have officially crossed the $1 billion mark in assets under management, and most people still have no idea what that actually means. They're staring at charts, complaining about red candles, while institutions are accumulating supply in silence. And here's the part most retail investors don't understand. Every XRP entering an ETF is removed from the liquid float permanently. That's structural scarcity. When the supply on the open market dries out, price doesn't rise because of hype. It rises because there's no liquidity left for new buyers. Right now, almost 500 million XRP is already locked away inside regulated ETF structures. These funds trade over $28 million worth of XRP every single day, and they're doing this with zero marketing, zero hype cycles, zero retail FOMO waves. This is pure institutional positioning. Bitwise, Franklin Templeton. These are not momentum gamblers. These are some of the most conservative, methodical asset managers on the planet. The very fact that they are positioning early into XRP tells you everything you need to know about where they believe global settlement infrastructure is going. And the end game is obvious. Steady inflows, compressed circulating supply, reduced volatility, and price discovery driven by demand instead of emotion. A regulated pipeline that quietly absorbs supply day after day, while the XRP ledger expands utility behind the scenes. This is how legacy finance transitions into crypto rails, not by noise, but by structure. The numbers for December are staggering. We've seen inflows ranging from roughly $12 million to $50 million per day, with an 11 to 13 day sample averaging roughly $30 to $40 million daily and XRP trading slightly above $2. This translates into roughly 6 to 20 million XRP per day being absorbed into ETF storage. Imagine that. 6 to 20 million XRP removed from circulation every single day, locked behind institutional custody, inaccessible to the open market. If this momentum continues through the remainder of December, let's call it 15 to 20 US trading days, funds could easily accumulate an additional 100 to 300 million XRP. Add that on top of the roughly 400 million already locked, and you begin to see the long-term impact. Another few months at this pace, OTC desks dry up, liquidity thins out, market makers start competing for supply, exchanges begin struggling to source XRP for order books, and the price no longer needs hype. The mechanics alone will force upward pressure. That brings us to the conversation between Sal Galbert and the gentleman interviewing him, because it's a perfect example of two people who both understand pieces of XRP, but not the full picture. That's still valuable, though, because it shows how the narrative is shifting from the outside. Sal explains that XRP is not some speculative token. It's a bridge asset, an institutional tool built for high-speed cross-border settlement. And America is only now beginning to see the open regulatory framework that allows that potential to surface. He points out something important. Ripple has spent years building the infrastructure, years creating relationships, technical integrations, and settlement pathways across global banking systems. Ripple is not a hype company. They're disciplined, methodical, and single-minded in execution. The rails have already been laid. The ledger is already being adopted. The uses are already being tested, scaled, and positioned. And the only missing piece in the United States is complete regulatory clarity that allows banks to begin tapping into this system openly. S mentions the RLUSD stablecoin, adding that most of its liquidity sits on Ethereum rather than the XRP ledger. He's correct there, and it's a point often misunderstood. Ethereum's liquidity is deep, and a new stablecoin naturally gravitates toward the deepest pools first. But as the XRPPL expands its tokenization ecosystem, liquidity will begin migrating onto the ledger. Just like developers, institutions, and financial tools have already begun the shift. The ledger is fast, scalable, and built specifically to support real-world assets. In time, RLUSD will likely balance out as XRPL liquidity increases. Then comes the point he emphasizes most clearly, the Clarity Act. Once the Clarity Act passes and banks have a well-defined framework to participate, the XRPL is going to explode in adoption, not because of hype, but because global money flows through the United States at some point. Once US banks get the green light, global banks will follow, and XRP becomes the neutral bridge asset between these systems. The interviewer brings up a fascinating angle as well. XRP is not designed to behave like Bitcoin or gold. Those assets are static stores of value designed to sit in a vault and appreciate based on scarcity. XRP is a utility asset. It's designed to move, flow, facilitate transactions, serve as the connective tissue between currencies. So how does increased adoption translate to price? The answer is actually simple: liquidity demand. When XRP is used to move trillions of dollars across borders, the demand for liquidity rises. When demand rises and supply remains fixed, price rises until there is enough liquidity at higher price levels to support the flows. That's why volatility decreases as utility rises, but the long-term curve grinds upward. And if adoption spikes suddenly, price responds suddenly. This is the dynamic institutions understand, and it's why they're accumulating XRP before the masses catch on. Now let's pivot to something that might be even more important than the ETF numbers. WisdomTree released a report showing that XRP is the only major cryptocurrency with sustained institutional inflows across every region on Earth: Europe, Asia, the United States, the Middle East. Every single area with regulated investment products saw consistent money flowing into XRP. Even during a month when nearly every other crypto product experienced heavy selling, XRP remained the exception. This year alone, institutions have added $549 million into XRP, more than Ethereum, more than Solana, which has been bleeding, and more than every other altcoin except Bitcoin. And that's remarkable because outside the US, investors added almost exactly the same amount of fresh capital into XRP as they did Bitcoin, roughly $252 million. That's dollar for dollar par. But Bitcoin products are 25 times larger, meaning proportionally institutions prefer XRP 25 to 1 compared to Bitcoin in these markets. In the US, synthetic XRP products took in $241 million this year, dwarfing Solana's synthetic products, which only took in $26 million. Meanwhile, Bitcoin and Ethereum ETFs in the US lost $6.44 billion in November alone, while XRP products gained. Professional capital is flowing. Global capital is flowing quietly, consistently, and strategically into XRP. And with all of this happening simultaneously, the clock is ticking toward a supply crunch the market is not prepared for. This is not financial advice. When analysts talk about liquidity cycles, they usually frame them around the Fed, bank reserves, treasury issuance, all the traditional macro levers. And all of that is important, no doubt. But those models don't explain why certain assets, especially settlement layer tokens with real throughput, tend to decouple from liquidity contractions at key inflection points. Historically, these moments arrive right when demand begins shifting away from speculative trading and toward high-volume transactional settlement. That's what happened with stablecoins between 2020 to 2022. That's what happened with smart contract gas tokens when enterprise adoption began to rise. And based on the data we're tracking right now, XRP is showing the exact same signs, but at a much larger scale. And the catalyst is not hype. It's not a narrative. It's not retail speculation. It's throughput, raw usage, transactions tied to actual economic value. The quiet rise in institutional settlement rails is happening so subtly that it's almost invisible unless you know where to look. But there are a few breadcrumbs that give away everything: spikes in cross-border settlement requests, growing flows from FX-linked corridors, and the reactivation of liquidity pathways that were dormant during the bear cycle. None of this gets headlines because it doesn't pump price overnight. But it does something far more important. It builds pressure, the kind of pressure that eventually snaps into price discovery. Now combine this with the reverse carry trade dynamic, where liquidity gets yanked back into US assets as global yields compress, and you start understanding why XRP's setup is unlike anything else in the market. XRP historically performs best during periods of structural liquidity reallocation, not periods of euphoric risk on speculation. It tends to be a phase shift asset, meaning it doesn't rally because everything else is rallying. It rallies because the system underneath it is changing. And right now, that system is undergoing one of the fastest transformations we've ever seen. To see the full picture, you have to understand what institutions are optimizing for right now. They're not seeking volatility. They're not chasing meme coins. They're looking for instant settlement, low counterparty risk, and predictable liquidity pathways. That's why so many desks are moving away from high-friction assets. They can't use them in real settlement environments. XRP, on the other hand, is built for exactly that. And when reverse carry dynamics accelerate, when capital floods back into US pipelines and global liquidity becomes fragmented, institutions need assets that can move across borders without getting stuck in the cracks. XRP is almost uniquely positioned for this moment, and here's where retail investors miss the plot. They think price moves first, and then utility catches up. But historically, in every major financial shift, utility leads price, not the other way around. Think about every payment rail upgrade in the last 40 years. Swift expansions, AC modernization, Fedwire, mobile banking, real-time settlement platforms. The infrastructure always gets built first, quietly, and then suddenly. Everyone looks around and realizes that the market reprices almost overnight. We're seeing the early stage of that same pattern with XRP right now. One of the most overlooked signs is the reactivation of corridors that went quiet during the crypto winter. Whenever those corridors light back up, it's never random. It usually means a liquidity provider is preparing for a throughput expansion. And when LPs prepare for an expansion, it means someone, often a large institution, is about to begin flowing real volume. Real settlement demand is like gravity. You don't see it directly, but everything is pulled by it. And based on current data, XRP is experiencing gravitational buildup at a speed we haven't seen since the 2017 to 2018 cycle. And here's the wild part. None of this has fully hit price yet. It's all pressure building underneath the surface. And when you combine structural utility buildup with a macro liquidity pivot, especially one driven by the reverse carry unwind, you get a very rare setup. A setup where an asset doesn't need retail hype, doesn't need meme speculation, doesn't need a bull mania. It just needs the system to keep shifting in the direction it's already moving. And historically, once that shift completes, XRP tends to reprick violently and suddenly. Let me tie all of this together with what might be the most important point of the entire series. Liquidity cycles determine when a move happens, but utility determines how big that move becomes. The reverse carry trade dynamic is setting the when. The institutional settlement shift is setting the how big. And for the first time in years, these two pieces are aligning at the exact same time. That alignment is rare. It's powerful, and if the data holds, it could lead to one of the most significant revaluations XRP has ever experienced. And while most investors are distracted by day-to-day price swings, the institutions positioning behind the scenes aren't thinking in days or weeks. They're thinking in frameworks, liquidity regimes, settlement flows, transactional throughput, corridor activation cycles, demand-side elasticity. They're mapping out the exact same patterns that showed up before every major settlement layer expansion of the last decade. And right now, those patterns are lighting up around XRP, not in hype metrics, not in headlines, but in the underlying structure of its ecosystem. And so the real question becomes, who's prepared for that? Who actually understands what's happening underneath the surface? Because when this shift breaks into the open, when liquidity finally snaps back into high throughput assets, the window will not stay open for long. These moments never do. They happen fast. They reprick fast, and they reward the people who were positioned before the herd figured out what was happening.